Market structure, the building blocks, the ABCs, the general profile of the market. Somehow this is where we also feel in our understanding of what markets are doing. But ladies and gentlemen, say bye bye to confusion. In this video will be clearing up everything that has to do with market structure and how we will be able to better understand it, and then be able to better understand key areas within market structure itself. Let's get into it. So last time around I did the whole let's be a YouTuber thingy, and then ended up scripting the videos. The results of that are varying, to say the least, but moving forward I'll be using bullet points instead. I want that raw authentic feel. So very quickly, if you've been involved in any sort of trading or visualization of charts, or if you've seen any price movements, whether it's stocks or whether it's currencies, whether it's anything, I'm sure you people most of you should be familiar with the terms bullish market and bearish market. You know what, or at least you should be familiar to a certain degree with what an uptrend is, and what a downtrend is, right? So not just forget about market structure or technicals right now. Think of anything out there. Think of any currency. You use currencies out there. You use currencies, you know what it means for a currency to rise and then for a currency to fall, right? It's the same when it comes to other things too, whether it's commodities, whether it's your phone, the prices of your phone rising and climbing. So visualization up, prices rising, prices going down. But here is another one that maybe some of you are not familiar with. We have sideways moving markets. Three types of trends, right? We have the initial one that we put, the uptrends, the sideways moving markets, the downtrends. So these are the basic building blocks of market structure. This is the sum of market structure itself. But here's the twist, right? Markets do not move exclusively in one direction. Markets move like this: push, exhaustion, push, exhaustion, push, exhaustion, push, right? This is how terrible drawing, but then this is how markets move. Market do not move linearly. You won't see something like this without this push, without this exhaustion, without this push, and then without this exhaustion. You won't see something like this. It happens in rare instances, but then if you ever see something like this, there is, let's just say there's a problem in the market, but we'll get into in the future. But markets, like I said, do not move exclusively in one direction like this, right? They're moving push, pull back, push, exhaustion, push, exhaustion, push. So when you see this pushes and exhaustions, pushes and exhaustions, pushes and exhaustions, this is what we define as a bullish trend and an uptrend in market, right? And then when you see, let me clear this up, when you see markets moving like this, push to exhaustion, push, exhaustion, push, exhaustion, push, moving downwards, this is a downtrend. So what causes this price movement? This is, by the way, a healthy price movement, right? What causes it? What causes it is price moves up, and then different people have their theories. We pull back to collect orders, and then we move and create new highs. So let's focus on this now. This push, exhaustion, push, right? When markets pushes, this right here is called a high. So see, this hasn't been created yet. When markets push like this, the highest point within this leg of structure is called the high. This is the highest point, high, right? It's called the high. And then the lowest point within this movement is called, I feel like I'm confusing you. Let me move this. Let me do this instead. Highest point, pull back. So the highest point is called the high, and then the lowest point that it pulled back to, remember we said it pushes and then it pulls back. The lowest point it pulls back to is our low, right? Now, so in an uptrending market, what we want to see is market creating highs and then creating lows, but then breaking those highs that we had created earlier to create new highs, right? This is what we expect from a healthy uptrending market. We have a high, we have a low created, and then we have a break of that previous high, and the market continues upwards. So this is what we generally consider a bullish market, right? So let's introduce a new concept in a leg of structure. By the way, this is a leg of structure. These movements like this movements are a minded drawing, but then these movements like this are what we call legs of structures. So within legs of structures, right, when prices creates a high within a leg of structure, it's called a higher high, HH, a higher high. And then when it creates that low, it's called a lower high. So in an uptrending nature, you have higher highs, and then when it pulls back and creates that low, it's called a higher low. You have your higher high and then you have your higher low. This is the nature of bullish markets. You have higher highs, higher lows. Let's copy this. Higher highs, more higher highs, and more higher lows continuously. So this is what we define as this is what technicals define as a bullish trend, when markets are creating higher highs and higher lows continuously. That is what a bullish trend is. You have this push, you have the pullback, you have the push, you have the pullback, you have the push, you have the pullback, you have the push. So we are understanding again the ABCs, right? When it comes to a downtrending market, we have a low created and then a high created within that low that doesn't break the previous low. We have a high created within that low, and then a new low is created breaking the previous low, right? And then another high is created within this leg of structure itself, and then a new low is created again. Again, the drawing is terrible, but then I'll make I repair this drawing. I beg. Low, pull back, low, pull back, low, pull back, low. Slightly better, but yeah, in an instance like this, when you see market creating a low and then creating a mini high and then creating new lows and then creating more mini highs, creating new lows, this is what we call a bearish market. So we have a low created, a lower low created, and then you have a lower high created. So notice how it's almost inverse of bullish trend. While a bullish trend is creating high highs and then creating high lows, this is creating lower lows because we are going down. So we have push down, lower low, slight pullback, lower high, push down again, lower low, and then pull back again for lower high. So the continuous creation of this is what is considered a bearish market across all instruments and whatever markets you're in, whether it's stocks, whether it's FX, whether it's phone market. Keep using phone as example, where regardless of the markets you're in, this is what's generally called a bearish market. And then the third type of trend is one where how we said the bullish trend creates higher highs and higher lows, and then the bearish one creates lower lows and lower highs. In a sideways moving market, the markets are not going anywhere. So like let's say last week the price of dollar is 1k USD, and then instead of usually you have price movements, right? You might see it climb by, let's say, 1,100 ish, but let's see between last week and now price didn't do anything and it's still 1,000. This is how it will be reflected. Instead of creating lower highs or lower lows or higher highs and higher lows, market would be doing this. So what do you notice being different from our previous legs of structures? How is this different from the rest? This created a low, sure, but then created a high, sure, but then it did not create a new low. Let me just quickly tweak this. It did not create a new low. It still maintained activity within this range, and then when it came to this high again, instead of breaking it, it did not break it. It reacted to it and then came down again, and then it's creating this zigzaggy pattern. This is what we call the sideways moving market or a consolidation. Markets will just be doing this without going anywhere. So these are the markets that we typically should avoid. But yeah, now that we've understood what the three types of trends are and high highs and high low creations, let's start getting a bit in depth into things. So we mentioned high created, pullback for a higher low, and then new high created, and then pullback for a higher low, and then new high created, right? This is price movement, right? But this is also key levels being created. So any area where a high was created and then a low was created is a significant point within the markets. It's a key level. It's what we call a key level. So when a high is created, that high becomes a key level 1, and then when a low is created, that area 2 becomes a key level. So once you start understanding these things, you're already building up a picture as to how prices should move. So wherever you see high, key level, low, key level. So even within bullish trends and bearish trends, right, key levels are turning points. Like I said, areas of value within markets. These are places where price are shown to respect or rally from. So you won't just see prices do not just randomly stop at an area or randomly just move at an area. Usually they go to places where others are, and then they react to those places, and then they move according to what your trend already is. So like I said, highs are key levels, lower highs are also key levels, right? So what happens when price comes back to a key level, and let's say now that we're in an uptrend. So when prices comes back to a key level, that's where we start forming trade ideas and trade setups. This is not a strategy right now, this is just me giving you a general example of how things work. So once you see prices coming back to key levels, usually what happens is they will react a certain way. It's either it rallies up, continues in the general direction it's been in, or it decides to change character, quote unquote. So in a bearish trend, this is what it would look like: low, higher low, lower high, sorry, lower low, lower high, lower low. Every single point is a key level. This low here is a key level. This lower high that created this lower low is a key level. This place is a key level too. Right now it's a bit choppy, but then it's for illustration purposes. So this is a key level, this is a key level, this is a key level. And once you start understanding those, you start building a general image of what market structure is and how to navigate market structure. So the how now, or the, let's say, implementation of it, but why is it relevant? So basic example, again, this is very basic things. We are doing the EBCs, we are trying to understand how markets move and how to react with those movements. So these are basic EBCs. Why is what we just mentioned important? Why is market structure important and key levels important? And how do they affect the way we see markets, right? So you just mentioned that if you see markets creating this, right, this is an uptrend. This is an uptrend. So if you can identify this, if you already identified this, you haven't yet identified this, let's say you just identified everything that happened before the red line, right? And then we can see that markets are creating higher highs and higher lows. We can position ourselves in such a way, okay, since we know that when markets are creating higher highs and higher lows, we are in an uptrend and there is a likelihood that markets will continue up. We can start positioning ourselves in anticipation of this guy right here, this lower high being created, right? So us anticipating this lower high being created puts us in a position where we're able to see, okay, if price comes back here and then I see dash, and then I know already markets are in an uptrend, I will consider taking a trade here, and then when you end up taking the trade, bam, goes in your direction, right? So this is again basic building blocks. So this is not a strategy, this is just basics to help you understand the way markets move. But yeah, once you know how markets move, you are able to anticipate the next, okay, should I say anticipate, yeah, you would be able to anticipate what's the next thing that might happen. So you already know that when markets push, they pull back, they push, they pull back. So in an uptrend, you've seen this push already, you are already expecting that you would see the exhaustion, the creation of the higher low. So if you already know this, you can start positioning yourself again in such a way that you are able to catch the markets here, and then eventually when the continuation happens, you would be in a trade, right? So basic understanding of how markets work and behavior. So with that understanding also, if you see markets doing this, creating the highs, high, low, and then suddenly we start seeing this, right, markets not breaking previous highs, and they're not breaking lows too, just staying in this range, becomes a cause for concern. You're like, okay, what's markets doing? What are markets doing? And then it now starts doing this. And this is the opposite of this, right? So it went from creating high and higher lows, high highs and higher lows, to going sideways, consolidating, to creating lower lows and lower highs, lower lows and lower highs. So if you are in markets and then you see a bullish trend, then you see a slowdown of that bullish trend, you see that markets are not doing anything, you can start anticipating that, okay, maybe seeing as it's not creating new high highs and new higher lows, maybe that's a sign that markets are slowing down, or maybe markets want to reverse, right? And once you start seeing this right here, once you start seeing this lower lows being created and lower highs being created, lower lows being created, lower highs being created, you now know that, okay, this market has shifted from being in a bullish trend to now being in a bearish trend, right? And this is why it's important. This is why the basics are important. So in this instance here, we would see this. We said earlier that every single high is a key level, and every single high low is a key level too. So if we had marked out this high low here, and then we marked out this high, and then instead of prices breaking the high that we had marked out, we see prices failing to break, it comes back, but then instead of doing like what it did here, came back and then broke, it stays at the key level, it comes back again and then it stays at the key level, comes back again and then it stays at the key level. You get the point? And then eventually it breaks this our higher low here, breaks it, comes back to the key level, and then continues down. So once we start understanding how markets move, and once you start incorporating patterns, the picture becomes clearer, right? So this right here, already, if you had seen this and then we had positioned ourselves in such a way, like, oh, okay, it's like markets are slowing down, maybe this bullish trend is ending, and then we see a break of our, what's it called, higher low, and then we see prices comes back to the key level. Earlier we said that higher lows are key levels and then high highs are key levels too. Higher lows indicate when you see a higher low broken, it is if a bullish trend is in place. So this is something I should explain. When a market is creating high highs and high lows, high highs and high lows, that market is bullish until the market is bullish until the last major higher low is broken, retested, and the markets continue down. So as long as this last major higher low isn't broken, markets are still in a bullish phase. But as soon as it's broken, we should start considering that maybe markets are changing character, and that the trend will change. So as long as markets are again respecting this higher low here, then it's still bullish, the markets are still bullish. But then as soon as we start seeing a break of this higher low here, we should start realizing that maybe markets are changing what it's doing. Maybe this bullish trend that we've been riding for a while now is about to change. So that is why it's important. That is why your higher highs and higher lows are important. That is how you understand what markets want to do. So quick recap, markets don't move exclusively in one direction. Said that already. They move in pushes and exhaustions. Push, exhaustion, push, exhaustion, push. And then we have push down, exhaustion, push down, exhaustion, push down, exhaustion, push down. This pushes and this exhaustions, the push is called a higher high in the case of a bullish market, and then the exhaustion is called a higher low in the case of a bullish market. So in the bullish market we have higher highs and higher lows, higher highs and higher lows, higher highs and higher lows, higher highs. In the case of a bearish market we have lower lows and lower highs, lower lows and lower highs, lower lows and lower highs, lower lows and lower highs. This is important because again, every single time a high is created, that becomes a key level, and every single time a low is created, that becomes a key level too. It becomes a significant point in the markets, a point where markets might come back to either break character or continue rallying in the direction it had been moving. So every single one of these places, significant area, right? Significant area, significant area, significant area, significant area, significant area. The reason why key levels again are important is because prices do not just move out of nowhere. When a high high is created, key level. When a higher low is created, key level. And then when a lower low is created, key level. Lower high created, key level. Markets do not randomly just move without it being a key level. You need a key level for market to either start moving up or start moving down. It won't just randomly from the middle of nowhere just start moving. So in order for markets to move, you need to be able to identify key levels where previously markets have moved. The fuel, quote unquote, let's say fuel that the market needs is within these key levels. So yeah, bullish trend, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. Sideways moving markets, not creating highs, not creating lows. Bearish market, lower low, lower highs, lower low, lower highs, lower low, lower highs. And then each area is a key level. You can't go over the video again multiple times until you get the basics of what we are trying to do, because as much as incorporating everything might be technical and might be what's the word to use, complicated a bit, these are the foundations, and every single thing that you will learn moving forward is almost based off this, right? So if you understand this fully, every single thing becomes a bit easier. Understanding them becomes a bit easier, and then implementing them too becomes a bit easier. So understand these foundations, because as much as they look like foundations, even I go back to them time to time to just refresh and be like, okay, this is how this happened. So yeah, understanding the basic movements of markets, and then knowing high highs and high lows, understanding that there are key levels within the markets, and understanding that if this place is broken out or if this place is respected, then markets are most probably doing this thing, or is probably going to do a different thing altogether. So quickly, how is this reflected in charts? This is not the cleanest chart ever, but then we can identify this bullish push, right? And then within this bullish push, we can already see that markets are not moving exclusively in one direction for no reason whatsoever. What the market is doing is doing this and doing this, and then doing this, and then doing this, then this, and then this, and then this, right? So already you're able to identify your lower highs, your higher lows, and then your higher highs, and then your higher lows, and then your higher highs. So like we previously mentioned, you can see this is a push, and then the creation of a higher low, and then the creation of a higher high, and then the creation of a higher low, higher high, higher low, higher high. Downward trending scenario. This is a market going down, right? And then you can see here too, it's not moving exclusively down, it's push down, pull back, push down, pull back, right? So already you can see lower low created, lower high created, 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 and every single one of these places can be a key level, right? You can see already I didn't do that for the bullish variation, but you can see already this can be a key level. This right here can be a key level too. And then notice how prices gravitate towards these areas, right? Like in this case, it broke and then it came back to the area before it continued down. And this is how price generally moves. This is how price moves. We don't see exponential movements down. We don't see straight lines. You have pushes down and then pullbacks. Push exhaustion, push exhaustion. So once you start understanding how these movements occur, you are able to position yourself in such a way that you get to exploit these movements, right? So yeah, I think that's the sum of it. If you did find value in the video, you should consider again the button right there, the like and then the subscribing too. This is just the introductory part of what I am trying to do. I want to build foundations before I go in depth. We will be sharing a lot more free educational content when it comes to price action and trading. This is me laying down the foundation so that people get to understand the basics first, and then once we enter the more in-depth things, it wouldn't be as complicated for people. So again, this is me laying the foundations for you to be able to better understand what we'll be covering in the future. See you in the next one.